Hello. In this video, I'm going to give a brief overview of financial ratios, what they are, why we use them, that sort of thing. We'll then have some follow-up videos that discuss some of the more common categories and examples of financial ratios. So first, what is it? Very simply, a financial ratio is one financial number divided by another. So for example, contribution margin uh, is a ratio that sort of measures is related to profitability, and so your contribution is your revenue minus your variable costs. And if you divide that by revenue, then you get the contribution margin as a percentage. So obviously, what you would hope is that the contribution margin's higher, not lower, because that's what's left to pay off fixed costs, and then whatever's left after that obviously is profit after taxes and all that good stuff. So it can be very insightful. Why do we use them? For a number of reasons. One, it can allow us to compare across firms or across the same, different periods for the same firm. And so sometimes those are called common sizing. You might do that to common size a balance sheet or an income statement between a couple of companies that are just different sizes, so that rather than looking at their absolute dollar values, you're looking at what portion of their balance sheets made up of different kinds of asset accounts or that kind of thing. So if you're doing that common sizing, then the income statement would be stated as a percent of revenues, and balance sheet items would be stated as a percent of assets. Um, so the other thing is that you can calculate other ratios, not necessarily just based on revenue and assets, um, that will give you insight as a manager into making improvements in a business or tracking what's going on in a business, and that's really the point here. Other things that we'll point out, because it's kind of relevant for later in the class, um, companies and industries often manage to certain ratios. So, for example, they may have a certain variable cost ratio or profitability or asset management or liquidity ratios. Um, and because they manage to these, then number one, if you were going to work for a firm and then forecast what they're going to do into the future, you could use that as a reasonable set of assumptions or a range of assumptions for kind of ratios between values going into the future, and that helps you with your forecasting. Or if you are looking at a new business and you can find out what sort of typical ratios in your industry are, then you can use that as part of your forecasting going forward. So we will find these ratios very useful as we go forward with forecasting as well. So what are the common financial ratio categories? Um, there's short-term liquidity that really speaks to whether or not you have enough money to meet your short-term bills. Long-term liquidity, whether in the long term you have enough money to pay all of your liabilities off completely and still have something left over for equity holders. Asset management, which speaks to what kind of performance you're getting out of your assets. Market value ratios, which really speak to the comparison between book value and market value of things, gives you a perspective on whether the market perceives that you're creating value, destroying value, that kind of thing. And profitability ratios that really speak to return on some sort of investment number, usually. Um, Couple of quick things, some issues in financial ratios before you get too carried away with them as sort of a simplification. Um, there are times where it may not make sense to compare ratios between companies or between periods for a particular company. For example, sometimes there are formula differences. Even though ratios may have the same name, they may be calculated using a different input. This is more of an issue when you're just pulling financial ratios off of financial reports for a company instead of getting the raw financial data and calculating the ratios yourself. Even so, there could be accounting differences from one company to another, so that even though you have accounts that are named the same thing, they're not really treated the same way. Obviously, you can do different things with inventory, with FIFO and LIFO. There are decisions that can be made about how leases get treated, whether they're part of liabilities or not. So there are different kinds of accounting treatments that may bring into question whether or not you should be comparing ratios. And there can be industry differences or even business differences inside of an industry. So with some of the ratios, even though you calculate them the same way, the accounting's the same way, the business is so different or the industry is so different that simply noting that one of them has a higher ratio or the other one has a lower ratio does not immediately conclude that one company's better and the other's worse, or vice versa. It may just be the nature of being in that industry. And so choosing to be in that industry requires that the ratios be in a certain range, in which case, comparing between them is like comparing apples and oranges. That's really all there is at a high level. Next, we'll sort of jump into individual ratios and start talking about them.